Okay, before we head in, and we do have a lot to talk about this week, just some notifications here for the applied level. Global ship lease is now up, GSL. This is a container shipper. I've used a new format on this as opposed to the traditional 10K walkthrough that I do. I've used a new format. So as you're viewing it, leave a comment. Let me know what your thoughts are versus this format versus a traditional 10K walkthrough. You can leave a comment under the video on the site. August 25th, that will be the last day for new positions in the market outlook. After that, they move to the applied level. So beyond today, there will be 3 more updates, the 11th, the 18th, and the 25th for new positions. And after that, they disappear from the market outlook. And keep in mind, September, we start financial modeling using Excel. We're going to replicate what I think is a pretty good financial model, but we'll figure out how we would build it in Excel if we built it on our own, and then we'll use a target company to evaluate. I still think it would be fun to use Tesla for that one. Okay, let's head in. Let's begin with the economic data from last week. Lots of stuff to talk about. Then we'll move on to yields. And oh boy, did yields change. What a week duration had. Last Tuesday, out of Mexico, GDP growth rate year over year, a preliminary look, up 2.2%. The estimate was for 2%. The previous was 1.6%. This is consistent with US GDP as well, where the preliminary look, the first look at Q2, came in above what Q1 was. So Mexico suggesting that growth is accelerated in the second quarter. The US suggesting that growth is accelerated in the second quarter. That looks pretty good. Consumer confidence for the US, 100.3, up from 97.8. The expectation was for 99.7, 100.3. At this point during the week, you're saying things are looking pretty good. JOLTS, still quite a few job openings, 8.18 million, but down from 8.23. So there's the jobs market moderating slightly. The quits rate at 3.282, down from 3.4. So people are staying in their jobs longer. They're not getting those big wage hikes by jumping around, so may as well stay where they are. This is all good news. So as we leave Tuesday, we're probably feeling pretty good about the economy. Wednesday morning, the always wrong ADP, forecasting 150,000 jobs for Friday. Or the forecast, sorry, was that they would say 150. They're forecasting 122, which is about the closest I think they've been in a long time because it came in at 117. Revised the previous month up to 155. I cry foul on this because the real number was 179. You were off, so what are you doing? Saying, hey, maybe we were a little bit closer. I mean, why would you be revising numbers anyways? I thought the idea behind ADP is because you're processing payrolls, you have the number. To revise it after closer, I think, I got to cry foul on that. It's just so your time series looks a little closer. I don't know. I don't know that I would ever use an ADP time series for anything. Getting to Canada, Canadian GDP for May, and then we have the preliminary for June. For May, 0.2. Expectation was 0.1. Let's be clear, it was 0.156. Had it come in at 0.149, it would have come in at 0.1 for the difference of 0.007. So it's not a difference of 0.1% because they're rounding to one decimal place. It's the difference of 0.007%. It would have come in at 0.1. I just don't understand this reluctance to use 2 decimal places. When there's so much information in the second decimal place, why keep it at one decimal place? I don't see the benefit of that. The preliminary for June, growth as well, 0.1%. But again, you would have to look at what the second decimal place is. The preliminary read doesn't give you the data to calculate the second decimal place and the third decimal place, but the second one does, so we'll have to wait one more month. Very backwards looking. That's May, that's June. But notice May does come in higher than expectation. Whatever the expectation was, if it was 0.1, I'm sure they were thinking 0.100 on a forecast. They're not thinking, well, it'll come in at 0.149. I don't think they were thinking that. 0.156, so let's say it's 50 basis points more than what they thought. So Mexico GDP growth second quarter come in above expectations. We saw that the U.S. second quarter GDP came in above expectations. This is May and June, which is the second and third month of the second quarter, and May so far coming in above expectation. I don't know that we're finding fault with much of this. The employment cost benefit we got that morning, 1% down from 1.1. That is good. You want to see moderation there because wages are the heart of every business. It's going to be inflationary if they're rising. Employment cost in just terms of wages for the second quarter, 0.9, down from 1.1. That's 3.65% annualized. The Fed says, has said, or alluded to in the past, that an ECI of about 3.5 is consistent with a PCE of 2%. It is consistent. That's 3.65% annualized. Kind of looks like the pilots are landing the plane nicely. Just to go back to Canadian GDP for May for a second, just to see what contributed. This is in Canada. It's broken down by the sectors that contribute. 3 sectors in May took away: mining, oil, and gas, and of the 0.156, this is negative 0.024. It's a contribution. Wholesale negative 0.041, and retail negative 0.045. And what added? Public sector and manufacturing. Manufacturing big, 0.092. Public sector 0.077. If you double the 0.077, you get to 0.154. 0.156. In other words, the growth in the public sector is half of May's GDP. Another way of saying it is taxpayer spending supported half of May's GDP. Taxpayer spending when you already have a deficit, which means it adds to the debt, which means next year you can count on the Canadian government coming back and saying, look, the successful people are not paying their fair share, and we're just asking them to pay a little bit more, as they have for the last 50-some years, every single year. This is interesting here, this outcome for crude oil stocks and gasoline stocks. You had the right move on the day. You had a larger drawdown of oil than expectation and a larger drawdown of gasoline than expectation. Not just larger, significantly larger, more than double what was actually expected. So on Wednesday, both oil and gasoline were up 4.43% on the day. It was a good day Wednesday. And then you had a big drop Thursday at 10. If you look at the charts, 10 o'clock it began a drop that lasted well into the Friday close on ISM manufacturing, which we'll see on the next screen. So oil, even though it had a great Wednesday, and same with gas had a great Wednesday, oil ended down 3% week over week. It lost 2.84% on Friday alone. So almost the full loss week over week came just on Friday alone. Gasoline down 3.0% week over week. It lost 2.81% on Friday alone. But the read on Wednesday, if we look at the drawdown, more oil being used, GDP growth is energy intensive, and more gasoline being used, people driving more, that's a sign of confidence. If we stopped right here, if I didn't tell you what happened at the end of the week, if we just stopped here, you would think that this is pretty good so far. And this is Wednesday. Take you to Wednesday afternoon. The Fed did not cut rates, but seemed fairly open to a September rate cut. And there are some that think that makes sense, and there are, I think, almost an equal amount of people that think that's a mistake. They should have been cutting. They should already have been cutting. I'm one of those that think that they should have been cutting. They have the permission to cut. And if we accept and this question was asked about the lags. If we accept that monetary policy works with a lag on the way up, you must accept that it works with a lag on the way down. That if all the data seem to be going to the same place, and we are getting some soft economic data, that now was the time to do it. Why they didn't do it, I don't know. That was asked a couple of times. And actually, it wasn't asked of Powell. It was asked of Goolsbee. Bloomberg had an interview with Goolsbee, and it was asked a few times. And he says, "Look, I'm not going to say anything about." And he actually referred to it as secret meetings. "I'm not going to say anything about our secret meetings. You're going to have to wait for the minutes to come out." So we'll have to wait for the minutes to see if there was any conversation about, any serious conversation about we should cut today, and why are we not cutting today? What are we waiting for? But the market on, especially Friday, going into the close on Friday, really does believe that that was a policy mistake. And there was conversation about an intermeeting rate cut. I gotta push back on that. I don't think you're gonna get an intermeeting rate cut, because the Fed is not there to monitor the equity markets. In fact, from the Fed's point of view, it could say, look, you were pushing up to 22 times forward earnings. You were extremely overvalued. You're now around a little over 20 times forward earnings. So you've gone from extremely overvalued to overvalued. So from the Fed's perspective on the market, they can make the case that you're still overvalued. So we are not going to come and save you. But from the economy perspective, unemployment is still, low 4%. GDP growth came in higher than expectation. Inflation is moderating. It's not at 2%, but it is going down there. So inflation's really not the enemy right now. The economy's really not the enemy right now. There are a few warning signs in the economy, but there are a few warning signs on inflation. They could make the case that, we don't need a policy change right now. We're kind of balanced on our risks. They could make that. So the idea that, the market has dropped, it's not even a 10% correction on the S&P 500, by the way. NASDAQ's a 10% correction from what was some ridiculous valuations in some stocks. And when you kept pointing out that 7 stocks are carrying everything, and you get this pullback that's not even 10% in the S&P, and starting to scream for an intermarket rate cut, I don't think that's going to happen. But I do think not cutting was maybe not an economic mistake, but certainly a psychological mistake. Let's move into Thursday. This is pretty much where everything started to fall apart, right at about 10 o'clock. 8:30, got continuing jobless claims, came in higher than expected, 1,877,000 versus 1,860,000. And initial claims, 249 versus an estimate of 236, previous 235. For Canada, SPGlobal Manufacturing PMI 49.3 dropped to 47.8, and for the US 51.6 dropped to 49.6. Neither are good, but S&P doesn't really get the attention that ISM gets. That's the big one. And ISM, no help there. This is really what started the acceleration in the selling. 48.5 in contraction zone, expected to be less contractionary at 48.8, came in significantly lower, 46.8. Construction spending didn't help either, came in at negative 0.3, expected a growth of 0.2, negative 0.3, and the month before was down 0.4. And this is for June. When we look at the jobs report for July, we'll see one of the biggest job gaining categories was construction. Going back to ISM, the manufacturing, the employment index 49.3 dropped to 43.4. That's a big drop. New orders 49.3 down to 47.4. There was nothing good in ISM. Prices 52.1 increased to 52.9. That's the input prices, which could be seen as, well, that's still a bit of inflation hanging out there. None of that was good. Non-farm productivity for Q2, we would have expected to see this up. We had growth of 2.8%. Without really big job gains, average kind of job gains. So obviously productivity had to do some of the lifting here. Expectation 1.7. And unit labor costs, well, that came in from 3.8 down to 0.9. That's nice. Expectation 1.8. So that was good news. This was good news, but it was news that we'd already sort of anticipated. This is what really started it. And what made it worse was the growing conversation and belief that the Fed had made a policy mistake by not cutting, that they were going to cause a recession, that we had enough data for them to cut. The economy had been softening, prices are coming down, or price growth, not prices, price growth has been moderating, that by not cutting, you're sort of increasing the probability that we'll go right through the soft landing into the hard landing, because here's the soft landing. Now's where you land the plane, and they're not doing it. So this really just brought in the whole conversation of hard landing. And then after the jobs report, that's when we started hearing intermeeting rate cuts are coming. Going into Friday, we got Mexico's unemployment rate 2.8, up from 2.6. So that's not good. And then, of course, the killer was 8:30 non-farm payrolls for the U.S. And the rest of the day was one direction, straight down. Payrolls came in at 114. Earlier, with comparing with ADP, I said 117. My fault. It's 114. Previous month revised down to 179. Expectation was 175, so that is a fairly big miss. And then under the hood, it really didn't seem to get much better. The unemployment rate, 4.3%, up from 4.1. That caught everyone's attention. That's a big jump, but move it out, right, to a couple decimal places. 4.253. Had it come in at 4.249, which is a difference of 0.004, that would have printed a 4.2, not a 4.1, and you wouldn't have people saying, the SOMA rule was triggered, right, if you went out to more decimal places. 4.253. Average hourly earnings came in lower than expected, 0.2. The forecast was for 0.3, but this is neither good nor bad. It's bad in the sense of increased spending power for the workforce, but it's good in the sense of supporting the decrease in inflation. This is 0.228, and the previous month was 0.315. So it is 0.87 lower, not 0.1. Average hourly earnings up 3.63%. This is saying 3.6, 3.63. Previous was 3.8. The average weekly hours down to 34.2 from 34.3. The combination of average hourly earnings and average weekly hours creates average weekly earnings. That has come in negative 0.06, or basically flat. Sure, you got a little bit extra per hour, but you have fewer hours per week, so you're going home with pretty much the same amount of money. The diffusion index is what really sucked. For all industries, 49.6 in contraction. Previous month was 56. That is a big drop down. Hard to ignore that. Manufacturing, 38.2, actually increased to 45.1. So you can think, well, if this increased, if manufacturing increased, total minus manufacturing must have really decreased. There's no sugarcoating that one. That puts it from expansion into contraction over a 1 month period. Participation rate up 0.1. We will combine that information along with population growth to see whether or not we can accept the SOMA rule. And then we will ask kind of a significant question, which is, if you didn't know anything about it, would you know to react to it, right? Private payrolls up 97,000 from the 114. Goods up 25,000. Services up 72,000. Goods all from construction. So May and June's construction readings were not good. They were in contraction. July, all the job gains, all of them from construction. Services, healthcare added 57,000. Information technology lost 20,000. Looking under the hood of the household survey, it says there was a gain of 67,000, not 114. High school or less than high school lost 21. BA and up lost 76. The gains were in the middle of the distribution. Less than BA up 72. At least high school up 296. This was good news. Full-time equivalents up 448. Part-time equivalents down 325. This is sort of what you want to see when you do have job gains, is that a significant amount of them are full-time equivalent jobs, not part-time. Full-time jobs as opposed to being full-time equivalent jobs made up through part-time. 16 to 19 lost 170, 20 to 24 up 31, 25 to 54, the biggest segment of the workforce up 246, and of course more retirees happening. The 55 plus down 16. Let's look at the SOMA rule here, and then we'll look at this data down here. Whenever we do something in studies, quantitative studies, you have to look at the range of the variables included. So if you're including a bunch of variables that have a specific range, right? You have another one that has a specific range. And whenever you're forecasting, what you have to do is say, this is what we expect given the range of variables that we've had. That if you then used whatever model you have to predict something and you had variables out of range in your prediction, there is a question whether or not this model is going to be sufficient, because you are going out of the range of the data of which this model had created. So it just calls into question the validity of using that. Well, this is what we have to look at with the SOMA rule as well. There is a rule. It is the 3-month moving average for U3, which is the number we see here. The unemployment rate here given to us is U3. The 3-month moving average for U3 increases 50 basis points over the last 12 months. The economy has never avoided a recession when that has happened. That number is now 0.53. The moving average is now 0.53. I'm using data from FRED, from the Federal Reserve Economic Database, the St. Louis Federal Reserve Economic Database. This is their number, 0.53. I don't know if they go to more decimal places, but let's just accept it, 0.53. But let's just, look at things in perspective first, in terms of the variables. Now we can make a good case verbally for why we see that empirical regularity. That if unemployment increases by 50 basis points, it usually continues on. There's usually some momentum in the economy which creates more job losses after that, because if you take that many people out of the workforce, if you lower the workforce by that many people, it will hit demand, which then causes the next round of layoffs, which then causes the next round of layoffs, and so on. So maybe 0.5 is the tripping point, where it has affected aggregate demand enough that it begins this process. But what if, and I'm just going to take some stuff off the screen now, because I like to draw things out here. Let me just delete this part of the screen. What if you had a labor force of a certain size that was all employed? All these people are employed, and they're making a certain amount of money, and they're spending that money. And you have more people coming into the country, so the population, let's say that this was the initial population, the population has now grown, right? And some of this population coming in are adding to the labor force. So the labor force has now grown, but none of them have gotten a job. But the people who are employed are still earning the same dollar. The level of aggregate demand is still the same. It's just you have more people who would like to work but can't. You will see unemployment, U3, move up. But employment, if we look at it not as a percentage, but if we look at it as an aggregate number, employment has shown no change. It has not decreased, it has not increased. Nobody has lost a job. There are, in fact, maybe there's even more jobs than what there were before this whole process started, but there were more people coming in, or more people being added to the country, or more people aging into the workforce that couldn't get a job, that are looking for a job and couldn't get a job. This would probably signal that this economy is probably near full employment, given the structure of industries that exist. But you have some people who can't get a job. Would you then say, aha, we're going into a recession? If we're measuring it by just aggregates, you can maybe make the case that, well, that many people who are unemployed, if you look at GDP per capita, maybe it's in a GDP per capita recession. Canada is certainly in a GDP per capita recession. We've been in a GDP capita recession for a number of years now because of this, because of the level of population growth due mostly to immigration, without the ability of the economy to add jobs at the same pace. So this is why you need policies that match your population growth over a long period of time. If you accelerate your population growth in certain periods of times, it screws up your economic data. Let's see if we can make a case for this. Let's look at May to June, June to July. Let's look at population growth. It's model driven, so it's fairly constant from month to month. May to June, population grew by 200,000. June to July, population grew by 206,000. But look at the labor force. May to June, the labor force grew by 277,000. And June to July, the labor force grew by 420,000 because you had your participation rate increasing each month. But look at jobs. We didn't lose any. Added 179 May to June. June over May, or let's just say 179 was added during June. 114 added during July. So you're actually increasing the amount of people going home with paychecks, which is increasing the amount of aggregate demand by the amount that the incremental people who have jobs are going home with paychecks with. It's just that you have a labor force that is growing much faster than the jobs that are being created. For population growth, if you kept the same participation rate, let's say you had, where's our participation rate? 62.6. That means you have to add, for every 100,000, you need 62.6 thousand jobs, 62,600 jobs per month, just to keep the unemployment rate stable, just to keep it stable. So here you had an increase of population of 200,000. If you take 62.6, you would need 125,000 jobs to keep the unemployment rate stable, 179. However, the labor force increased by more than double that number. If we have a population that grows at 200, 62.6% of them enter the labor force. That would be 125,000 that enter the labor force. We created 179,000 jobs. If the labor force increased in proportion of the population, unemployment would have gone down in that particular month. It would have gone down. But look at the labor force. It grew by 277. Not by 125. Grew by 277. That's implying, for this 200,000 increase, a participation rate of about 135%. Look at the next month. Population grew 206. Again, multiply that by 0.626. You get to about 128,000 jobs just to keep the unemployment rate stable. We got 114. So the unemployment rate shouldn't have changed that much. There is a month that you can say, well, that's actually there would have been a slight increase in unemployment, and that would have been the bad type of increase in unemployment because the economy didn't even create enough jobs to keep up with population growth. But labor force growth came in almost triple what it needed to be. The unemployment rate mathematically had no choice but to increase, but not because of the reasons we would normally associate with the SOMA rule. Do you get that? This is your problem here, is your labor force is increasing at this incredible rate. And if the government puts in policies to encourage more labor force participation, what's going to happen to your unemployment rate? Even if you create jobs every month, if your unemployment rate is growing faster than the rate of the population, typically an economy can't create jobs at that pace. You're going to have a rise in the unemployment rate. I don't think the SOMA rule applies to data that is out of range like that, because you would have to go back in all the periods of time where it did trigger, where the rule said, okay, we did have a recession. Was the labor force growing at a rapid pace like this outside of what the population growth was? And if the answer is no for all of those, then what we have here is a situation where we have data out of range, and that this may not actually be the case. Now, let's take this one step further. If you did not know that gravity existed, you knew nothing about it, would you still fall off a building? And the answer clearly is yes. It would still have the same effect whether you knew it or not. In other words, your belief in it, your sentiment about it, has nothing to do with the outcome. But that is not the case with economic variables. If there is an economic variable that has had some kind of empirical tendency, and we tell everybody that it has this particular type of tendency, and whenever this variable does this, there's a tendency for this next thing to happen. You can increase that tendency by getting people to believe that once we see a certain thing happen, we think, uh-oh, this next thing is going to happen. We better prepare for that thing to happen. And in preparing for that thing to happen, you increase the probability that it happens because you hasten its occurrence. What if nobody knew the SOMA rule? What if it was never published? What if it was never discovered? Would the conversation on Friday have been as negative? The SOMA rule is being triggered. Never have we escaped a recession, which then caused the reaction that we saw. CEOs are going to look at this and say, the SOMA rule is being triggered, a recession is coming, we should rationalize our workforce now, ahead of this. We should maybe put a hiring freeze on and rationalize ahead of this. That the very existence of this could be enough to create its own existence. That we would then begin to act in ways consistent with the belief that this is true. But if we didn't know it, would we know to act in that way? Right? It's the difference between gravity, which doesn't care if we know it or not, versus something like this. And this is entering the whole field of behavioral economics, is that the economy is not like gravity. It's not something that happens whether you know it or not. It is something that happens in part of you knowing about it. That when we predict the future of the economy, it's not enough to predict the future of the economic variables, the real variables. We must predict the reaction to the knowledge of those variables existing at those particular levels. Add to that the uninversion of the yield curve. Early on Friday, that yield curve did uninvert. The 2-year dropped by more than the 10-year did, and just for a couple of basis points, you had an upward sloping yield curve. And we hear more and more, it's not the inversion of the yield curve, it's the uninversion of the yield curve that signals the recession. We did have that briefly along with the SOMA rule. What does that do to the psychology of people? Meanwhile, the economy is adding jobs. It is adding jobs. There is more money going home in paychecks in aggregate at the end of July than there was at the end of June. It's just that the labor force is growing, especially month over month, at a rate double the population growth. That's the problem here. Well, let's look at the effect of all of that. And really, it's 2 days. If you're looking at this effect, and you look at a chart for the week, you can start Thursday at 10 p.m. all the way into Friday at close. Have a look at where we are from the beginning of the year. Rates are lower across the board, all the way across the board, except for the 30-year. From the beginning of the year, from January 1st to now, rates are lower. Look, this is just week over week, by the way. Look at the 2-year, 50 basis point cut, almost 50 basis points, almost 50. Look at this, 40. For the 10-year, down 40, under 3%. There was a point early Thursday, I think early Friday, where the 2-year was actually below the 10-year, not by much, a couple of basis points, but it was there. We still have a curve inversion, but really not much. 8 basis points. We continue on with this for a couple of more days. You could get to either a flat curve or a slightly upward sloping curve. So curve flatteners, anybody who was playing curve flatteners over the last little while has worked out. The 3-month will be anchored by monetary policy, but it is a 3-month, so it is including the next Fed meeting. So it is starting to show some rate cut in there as we get closer and closer. This will probably this -11 will probably approach -25. So the money market to capital market inversion is going to hang out for a while until you start getting rate cuts here. But these are very long cycles for the inversion. That has always led to a recession. If you want to accept the SOMA rule, that's fine. Leading economic indicators have suggested that it's a recession for some time, although it has sort of backed away from that recently. And the economic data has been weak, that you can look at that and you wonder why on Friday afternoon, why the Fed didn't cut. Maybe if their meeting was 1 week later, they would have cut, and maybe that's why we have this growing conversation about an intermeeting cut, because as they saw ISM and the jobs numbers, maybe they're on the phone to each other saying, well, if we would have had this and the meeting, maybe we would have cut. But Powell did say, I don't know how many meetings ago, he was asked whether or not they get an advanced look at things. He says, if it's significant, if it's something that would be important, we would get an early look at it. That you can't discount that they didn't already know what the jobs report was. We can't discount that they have a meeting 2 days ahead of a jobs report, that they might have had a look at it. Austin Goolsbee did say it was a secret meeting. Maybe they saw it. Maybe they had it. You can't discount that. But my God, look at that. I never would, if at the beginning of the day I had to forecast, I would have said, yeah, I think duration wins, but not this way. Wow, this was way more reaction than I thought. In fact, I'm in the camp now of, okay, that's a little much, don't you think? It's a little much, but it is what it is. We still have this going on as well, right? You have the runoff, 24.3 billion down to 6.617 trillion. The balance sheet has run off 27 billion, 24 of that was from securities, so you have a net runoff 2.76 billion, that's small. Money market funds decreased 10.65 billion. Retail not coming along, increasing 7.78, both in government and prime. It's all institutional, negative 18 billion. Government down 9 billion, prime down 8.87 billion. Next, FOMC is 45 days away. I'm not in the camp of an intermeeting rate cut. Citi is suggesting that there'll be a 50 basis point cut in September. And if we look at the probabilities, 69% probability of a 50 basis point cut in September. Last week it was only 11.5. 25 basis point cut was where everybody was, 88.2, 31%. The weighting is on a 50 basis point cut for September, ahead of an election, with the Fed saying they're not political. Wow, this is going to be difficult for them to defend. The minutes I'm going to be reading those. July minutes, 17 days. ISM services in 1 day. Can ISM services pull the economy back from the brink here? If this comes in below 50, if it comes in like ISM manufacturing, you got another leg down. We'll look at the S&P chart to see how much further down we can go. For the peso, 4 days, you get CPI and you get the interest rate decision. I don't know if they're in a position to cut. I think they would. At 11%, I think they have some room to cut. And for Canadian economy, you have jobs report in 5 days. I know there are more Fed speakers next week. I just couldn't find a full calendar. I found Daly on Monday, Barkin on Thursday, but there'll be more. I think that'll be important. They'll get extra attention next week because the belief is they clearly made a policy mistake. The belief is they were too slow to raise rates and that they are going to be too slow to cut rates. But they're more afraid of their legacy in terms of what if they cut and that was the wrong thing to do and you end up with stagflation, 70s style type of inflation, and they got to raise rates later on. Nobody wants to be on that team. But I think they think if the economy does deteriorate, we can cut really fast. That they're willing to play chicken with the economy than they are willing to play chicken with inflation. I think next week, if whoever's speaking about these issues, I think we'll get extra attention. Look at this for December 18th. Look at the shift. If we go back last week and we say, at most, 3 rate cuts or less, the probability was 92.3% that you wouldn't exceed 3 rate cuts. You'd have one. You'd either have none, one, well, actually, there was none there. You'd either have 1, 2, or 3, but certainly not more than 3, 92.3. Now it's only 6.8%. There is a 93% probability that you will have 4 or more, up from 7.7%. And you can trace this all to Thursday at 10 o'clock. This all happened from Thursday at 10 to Friday at close. Effective federal funds rate still at 533. Reverse repo down 42 billion. We're at 338 for August. 327. April 15th was the lowest. TGA is up 86 billion. Reserves down 97 billion. So you got reverse repo down, reserves down. So given balance sheet runoff at 40 billion a month, 25.43 months, that's a big drop down from last week when it was 30 months. Both the reverse repo and reserves moving in the same direction, both of them negative. Okay, let's have a look at our real rates. This is consistent with what we saw on nominal rates, but pulling back about half the distance that nominal rates did, so break-evens are lower as well. Look at the break-even rate on the 5 and the 7, both under 2%. 10 years sitting at 2.04. Fed funds futures, that's where the story is. I've took a snapshot here with the Thursday close and the Friday close just to show you 1 day, the huge gap in 1 day, the difference. Q3 is pricing in 52 basis points of cuts. Q4, another 75 for 127 by the end of the year versus 25 on the SEP. If you had been long Fed funds futures for either December or January, those are paying off nicely now. I don't know that I would count for more than that. You'd have to have an economy that really starts to fall apart. You'd have to have some kind of really distressed scenario, I think, at this point to continue to hold to say, no, it'll be more than 127. It'll go to 150, 175, maybe even 200. I don't know that you're going to get there on sentiment. I think sentiment has brought us as far as we can. It's going to have to be a significant deterioration in the economy at this point to force the Fed to cut, even intermeeting and cut faster. There's something would have to fall apart very quickly. Given that we did add jobs, that you do have more people going home with, well, call it flat paychecks week over week, but more people with it. The amount of consumer aggregate demand has increased month over month. I don't really know. That I think that this is where you would be taking profit on your long Fed Funds futures. I wouldn't go short Fed Fund futures at this point, but hoping for more than 127 basis points here by the end of the year, hoping for more than 5 rate cuts being priced in. You must include a distress scenario. It has to be. Going into Q1, another two cuts there. Going into Q2, 1.5 cuts. So 210 cuts over the next 4 quarters would bring us to where are we now? Would bring us to 3.25 to 3.5 on the target range, from 5.25 to 5.5 over the next 12 months. In fact, going out to next July, Fed Funds futures 96.3 is an implied rate of 3.3%, which is pretty much where we would expect the effective federal funds rate to be, 3.3. Look at TLT, up 5.69 for the week. Here is Thursday at 10. Didn't really do much for TLT during the day. Pretty much ended where we began, just a little below 95.50. Ended at 98.19. That whole move was just Friday alone. SPX down 2.06% for the week. Lots of implied volatility. Now, I've made no changes to my position. However, I do think this is a little overdone. I think it's a little overdone at this point. I don't see much more upside, given that we've already priced in 200 basis points over the next 12 months. I'm not with it in terms of who the FOMC is, in terms of their personality and their willingness to do things. They're looking squarely at the economy and not the markets. I don't really think they care too much about a market that has gone from almost 22 times forward earnings to 20 times forward earnings, where the long-term average is 17. I don't think they care too much to say we better save a slightly overvalued market and try to get it back to significantly overvalued. I don't think that they're going to step in to do that. Looking at asset prices and saying the Fed should cut is the wrong thing. The economic data is weak, but as the Fed would say, it's come into better balance. You would expect this weakening at these high level of interest rates. That's not excusing that they didn't cut. I think that is a mistake, that they should have cut. But I cannot see much more upside. All the fear is priced in, I think. So I haven't made any changes yet, but into next week, depending on what I see, I may be willing to sell calls on the TLT that I do own at 100, 101, 102, because I just don't see where we're going to get more, unless, of course, you're betting on a distressed scenario. 30-year fixed rate mortgage, 6.73, down 5 basis points as of the end of Thursday. And the 10-year Treasury, Thursday over Thursday, down 28. Spread increased by 23 to 274. We go out to Friday, we have to use Mortgage News Daily. 6.4. Look at 6.73 as of Thursday, 6.4 as of Friday. So week over week, the 10-year Friday over Friday is down 47, 30-year down 38. That seems more realistic. 6.4 on a 30-year fixed rate mortgage. Looking at some mortgage REITs, agency, Annaly, kind of split between the two. I did sell more puts on Annaly. ABR up 1.75 week over week. After earnings, it looked good, then it didn't look good. The price in the market dropped below 13. I saw 12.90, 12.80. Then the investor call started. Still didn't get a lot of excitement there. Ivan Kaufman did talk about the short distorts, did name them specifically, and did address certain criticisms, certain transactions that were being picked on. He gave more explanation of that, which I think was needed. I think what really helped ABR that day was the 10-year dropping below 4% and staying there. That he had said previously that a 10-year below 4% really accelerates their business model. And as far as the quarter goes, but what were we expecting? We were expecting a kind of quarter. Earlier in the year, he said the next couple of quarters are going to be the most difficult part of the cycle. So if being profitable is the result of the most difficult part of the cycle, I'll take it. 25 cents a share gap. I think it was 48 cents a share on a cash basis, or 45 cents a share, which covers the dividend. No cut in the dividend at all. I think that signals confidence. I'm good with ABR. Nothing there would change my mind. Housing stocks, obviously not doing well. Very consumer sensitive, very economic sensitive. Lower interest rates helps them. Lower mortgage rates helps them. Up to a point. Once you start getting mortgage rates, in the 4%, low 4% range, home builders are going to have a lot of supply coming onto the market from existing homes. But if you have an economy that's going to, deteriorate, and you have a recession on the horizon, housing and autos, they hurt. DHI kind of just flat for the week. Interest rate sensitive sectors, the REIT index up 2.32%. Utilities, the big winner. I had Friday looking at all my screens, red everywhere except this one green dot, XLU. And then if you look at some energy, some of the utility companies, they were doing quite well. I also sold some more puts on NextEra, but 4.9%. That helped me a lot. So as you know, I was a couple of weeks ago, I reported I was short small cap stocks, IWM and IJR, and much earlier than that, I had told you that I was short ES. I was short the market, which allowed me to extend my long positions. One of the long ones I extended was a bigger play on utilities. So utilities paid off nicely. Short on IWM, IJR paid off nicely. A little bit of a Tesla short I had on there paid off nicely as well. Meanwhile, some of my long positions really hurt me. Net effect overall is I was down for the week very lightly, but I was down. Now that's my managed account, the one that I handle myself. I can't say the same thing for the external managed money, but what I will say about the external managed money is it is massively underperforming me. I'll tell you that much. Massively underperforming me. That I am of the thinking of how long do I continue with this. That as long as I've had managed money externally, I've outperformed it significantly. I'm just very nervous about having concentrated strategy where it's just one strategy. But it would really do well for my psychology to see a quarter where they massively outperform me. That would be nice, and I would say, okay, well, thank God I have that, but I have not seen that yet. So overall, because I'm balanced this way, I did fairly well. What punished me hard last week was Lamb Weston, as I disclosed last week. The 7250 puts were put to me, so I am now an owner of Lamb Weston. I also had sold puts on Goodyear Tire. That punished me as well, and I've been selling puts on GM, and I'm long GM as well. No help there, but where I am getting help is nice. Canadian REITs, I didn't get the help that I thought I would get, but they're not dropping off a cliff, but they're certainly not responding the way that U.S. REITs have responded over the last week. Housing price index for May, historical data here, flat. Case-Shiller up 1% for May, up 6.8% year over year. This puts it at another record, the Case-Shiller index. Pending home sales for June down 2.6%. Heading over to OAS, finally some reaction here, right? And this is only as of Thursday close. To get the Friday close, we have to wait till Monday. But high yield index widening 27 basis points on same on double B and triple C 22. Looking at July, the SIFMA data we have, issuance for July. This, you can read this both ways. I tend to read it as more confidence than concern. Confidence in the sense of companies taking on debt because they feel confident they can service that debt with their cash flow. You can make the argument that they see bad things coming, so maybe they're issuing debt to shore up their balance sheet. It would seem that if you saw bad things coming, you would anticipate lower interest rates in the future. You would wait to issue debt. However, you can issue fixed rate debt at a high rate, and then on top of that, overlay a receive fixed pay floating swap. All right, so you're paying the fixed rate on your debt, but you're receiving the fixed rate on your swap, and you are paying out a floating rate, thereby getting floating rate debt, turning your fixed rate debt into floating rate. Okay, well, maybe. Investment grade issuance, 125 billion in July versus 83 billion last July. And high yield 20.57 versus 6.73 through the month of July. I don't know. To me, that speaks more to confidence than fear. I just have a feeling that if it was fear related, you would probably pull back on the level of debt. I don't know that you would issue more debt year over year. Year to date issuance up 30%. Another big story from last week is the yen. 3 days of trading took it from almost 153 down to 146. That is a huge move in the yen. This is pretty much from July 10th. There is July 10th, the day before it started. July 10th to August 2nd, over 3 weeks, the yen went from 161.69 to 146.55, an increase of 9.37%. The BOJ did move, increasing 15 basis points to a range of 0.1 to 0.25. Pulling back on bond buying, they're going to drop their bond buying by 400 billion yen per quarter. And this was not unanimous, 7-2 vote. More to come if July economic outlook is realized. So they released their economic outlook for at the meeting, and they say if the economy unfolds that way, we would raise rates. However, they seem to indicate that 0.5 would be sort of a limiting factor, with it not being in their mind at this point in time. That they think that this 0.15 is too small to affect economic activity, and it is small, but it is something. And I think it's done more for the currency than it was done for inflation and economic activity. I think this was more of a currency move, and it did work. If we look at how the peso did over that period of time, 17.8377 and 19.18 is down 7.55%. Triple Q's 498 down to 447 is down 10.17%. And let's take something that would not even be considered in a carry trade, which is the Canadian dollar. 136 down up to 138 is dropped 1.867%. So look at this: strength of 9%, weakness of 7.5, weakness of 10, weakness of only 1.86. And if we're thinking that that there was selling of bonds, that the carry trade was from the yen to U.S. Treasuries, and that there was selling of bonds to repatriate to the U.S. dollar, you'd see yields increase because of selling pressure. Sorry, I have all yields up. All prices on bonds are up. All yields across the board are down. That is indicative of buying, significant buying of U.S. Treasuries, not selling of U.S. Treasuries. So the carry trade isn't there. It's somewhere else. So let's think about what a carry trade is here. It's you're borrowing in something and investing in something else. You can have an intra-market carry trade or an inter-market carry trade. Inter-market, usually you have upward sloping yield curves. You borrow short and you invest long in the same market. So you don't have currency risk, you just have investment and borrowing risk. When you're borrowing in different countries, you have currency risk. So if you borrow in yen in the money market by shorting securities in the money market. Or what you can do is just simply sell the currency, have a negative currency position. You'll pay the money market rate in interest. And you invest in the Mexican money market, for example, you get 11%. So there's the carry, 11% minus 0.1. You will make that if the currency stays stable. You have, in this trade, you have currency risk. When you're doing a carry trade, you want to try to minimize the amount of risk you have. Here you have currency risk. If you attempt to hedge out that currency risk because of the way currency forwards are priced, you would lose the differential between these two because the differential would be in the forward. If you buy bonds instead in any particular country, you have currency and duration risk, because if interest rates in this country increase, the bond value would drop. You have less of this currency to buy back this currency. So you have currency and duration risk. And if you invest in equities, you're taking on currency and beta risk at the same time. So the safest place to be in a carry trade is currency to currency, is money market to money market. Mexico offered the best at 11%, and it was a good performing currency. So we're seeing the peso down by in the neighborhood of where the yen is up. You know, up 9%, down 7.5%, that I think the peso continues to be weak as long as the yen continues to be strong. As long as you have an unwind of this carry trade, you will have a peso, I think, that continues to weaken. But I don't think the peso is weakening because of fundamentals of Mexico. It's weakening because of this trade, and an unwind doesn't last forever. So I have added to my long position for the peso. I have also sold more puts on EWW. The Canadian dollar sitting at 1.387, 1.39, I think, is where I would be interested in starting to look at going long the Canadian dollar. Okay, let's run through positions I have, and I'll update some of the existing ones. I have ABR. I'm short the 750 puts. That is helping pay for my 1750 calls, so I'm dollar neutral on that one. So if the calls don't pay off, it didn't cost me anything. I got the 750 puts to pay for it. I will add to ABR on weakness. If I can see the 10-year staying at this level or a little bit lower, if ABR weakens, if it drops from the 13, I see a 12, even an 11, I will add to it natively as opposed to with options. I will go long again. I want to re-enter that trade and hold it again, I think, for the next 5-6 years. It has been a very good friend to me, but that doesn't say that it hasn't treated me bad at certain times. I mean, there have been times where it has dropped significantly, and it's always recovered, but it still has dropped. I'm waiting for that. I don't want to buy ABR, I want to steal ABR. So as I say here, 10-year below 4%. It was a good quarter considering that we had no dividend cut. Nothing on the quarter alarms me at all. Borg Warner had good earnings and was well over $35. Looked like my position was in the money because they were put to me at 35 less the option premium that I got. My average price is 33.85. Doing good. I was going to hold it. However, we had market weakness and Borg Warner dropped again. 32.50 put for September and 30 put for September. I did sell that. You have high implied volatility. This is the 52, 26, 13, 73%, 77, 84% on the 13-week volatility. So I took the chance to sell that volatility. 32.50s, I got 125 for. The 30 puts, I got 55 for. I did that for September. Canadian apartment REITs. I am holding through earnings. I've done nothing. I've changed nothing with them. I've sold nothing over the past week, and I bought nothing over the past week. Although I did look at some options on CapREIT when I saw 47 print. It did dip below 48 for a bit. I looked at the 47s. I looked at a number of option positions. I thought, nah, yeah, I'll wait. They have earnings next week. I'll wait. So next week, August 7th, CapREIT. August 6th, Interrent, August 8th, Killam, and then the week after, August 13th, Minto. It was easy to find these. I went to Investor Relations, and there it was, which is why I struggle to understand how very significant companies like SPGlobal and SectorSPDR and LSEG cannot do the same thing. I struggle to understand that, because that hardly took me any time, and I confirmed it right from the website, so somebody help me with that. Anyways, I'm holding through these earnings. I'm not. I have no plans to hedge or sell anything into earnings. COMEX, FCX, HG, week over week, I added to FCX only. I added the September $40 puts. I got $1.26 for. Let's look at GM. GM is going to take a little bit of explaining to what I did. I moved from using using stacks to using strips. So let me explain what that means. When I sell a put, I'll look at the, let's chart out, I'll look at the price of a stock, it's dropping, and I'll say, well, I like this put over here, and let's go out to this point in time and give me this strike, and I'll sell 50 puts at that strike. That means that I have, at that strike, a stack. It's not spread out over a number of strikes, and it's not spread out over a number of months. It's a stack. A strip, on the other hand, would say, well, I'm not going to sell 50 puts at this price. What I'm going to do is I'm going to sell 10 at this price, and then every strike down for the next 4 strikes, so the 5 strikes, I will sell 10 on each one. That will lower the amount of capital that I need, and it will lower the level of how can I explain it? The change, because I'll get a lower gamma overall. It lowers the change in this, and it lowers the margin requirement, or the change in the margin requirement, because if this drops, the gamma here will be the highest, the change in here will be the highest, my margin requirement will increase the most. So I still get 50 puts across the whole thing, but now it's a strip. Another way to do a strip is to say September, October, November, December, January, and you're going to do 10 across each of these at the same strike price. And you're going to sell 10 of these at the same strike price. I decided to use a strip at the same expiration, but across different strikes. When you're doing this, it helps to go out long if you plan that this is the first step of a risk reversal, because your risk reversal will be short. What does that mean? It means that I would rather sell puts 4 or 5 months out to finance a call that is 2 months out, because I can do that a couple of times. So here's what I did. Implied volatility on GM, the 52, 26, 13. So the 13 week is 92%, 86% on the 52. Here is the skew, and I've got October, November, December up, and they're all fairly close together. If one was significantly elevated, that would be the one that I would choose. When I look at it over time, November is elevated over December because you have earnings near the end of October, so November will be the front month that will catch the volatility from earnings. But December is still elevated from where September and October is, so I chose December. And I sold 6 in a row. 41s, 40s, 39, 38, 37, 36 as a combo, as a strip. Average strike is 38.50, premium is 11.20, which is nice. 20.2% on invested capital, given the margin that I have to give, with 139 days to expiration. That's 53% annualized. If I had done 6 at 41, so basically you're saying if you do a strip 1, 1, 1, 1, 1, 1, you can do as many of them as you want. You could do 10, you could do 20, you could do 30. It depends on how many you want. But let's say that you're comparing just a strip of 1 versus 6 at 41. The return on invested capital is 23.99 versus 20.2. Your break even is 38.04. Let's look at where my break evens are on these. Now, there's only one break even point here because you sold everything at $41. Based on, I think it was paying almost $3, $2.94, I think, or $2.96 it was paying. Your break even is 38.06. You got one strike, one break even. Look what I have here. If it's put to me, and I got the different strikes that it is put to me at. If it's put to me at 41, my break even is 29.80 because I got 11.20. So if it's put to me at 41, my break even is 29.80, not 38.04. If it's put to me at 40, my break even is 34.90, not 38.04. Put to me at 39, I get a break even of 36.26, all the way down to 36. If it drops all the way to 36, and all of them are put to me based on the premium that I got, my average price is 36.63, not 38.04. So I get a better protection on the downside. I get equivalent, almost equivalent return on invested capital. It will be a little lower, but I'll get a lower gamma, so that the change in my margin requirement is going to be significantly lower than if I had done a stack as opposed to a strip. So that is what I did with GM. Here's my thinking on GM. The market doesn't give them respect. They're going to buy back more shares. We know they're going to buy back more shares. They said they were going to buy back more shares. Their plan is to reduce their share count under 1 billion. Right away, I know they're going to buy back more shares just on that alone. But he did say we will continue to buy back shares if the market does not give us the price that we think we deserve. Didn't use those words, but that was his message. The market will not show them respect. It won't, and they have huge free cash flow. So they're going, it would not be surprising one bit if they do another major share buyback going into the fourth quarter. Would not surprise me one bit. At some point, someone's got to look at this company and say, given the amount of cash flow this company is generating, it makes sense to own them. Whether it be private equity, whether it be a Warren Buffett that wants to put another great brand in its portfolio. It did own GM at one point. Whether it be crazy Tesla, which then says, look at the capacity we now have. We're adding another 6 million cars a year that we sell. They already have a robo-taxi business. They already have EV plants. They already have battery plants. Tesla could bring its EV capability over. They would pick up Corvette. Now they got a Roadster. They would pick up Cadillac. They would pick up GMC. They'd have a full lineup of vehicles, right? So at the valuation that they're priced at that ridiculously low valuation, at this point in time, they're priced at a little over 4 times forward earnings. To not own them, to me, is ridiculous. So that is why I have no problem continuing to sell puts. They drop below 40. I start seeing 39, 38. This guy really runs to the top of my conviction list right away. This would be my number one conviction buy, which means I would be willing to increase the level, the limit on what I'm willing to hold in one particular stock. But I am just if there wasn't the share buyback included, if there's no share buyback going on, I'd say, well, I'd like some position, but certainly not this big. But being that they've basically set it, I'm in. If there's going to be 10,000 or 20,000 or 30,000 shares left over after they finish buying everything up because they get no respect, I want to be the one owning those 20,000 shares. All right, more positions here. It was a busy week. Typically, this is sort of the typical process that I follow is when markets are red, when everything is selling, that's when I'm a buyer. That's when I go in, and especially with implied volatility, because implied volatility is heightened. I really want to sell that. Lamb Weston 72.50 puts, they were put to me. My average price on those is 71, and I still have all my other options. Now I just wait. Wait till the August expiration, which is in two weeks. See what happens there, and then I'll make an adjustment, or maybe I won't do anything, depending on whether the put, whether the $60 put I sold for August gets put to me, which would significantly lower my average price, or it doesn't get put to me. Then I will roll that put forward and sell it again. Goodyear Tire, not good, not good at all. I am on hold there. I will sell $10 calls if the price recovers to 10. It was flirting with 10, a little over 10 on Thursday, and I thought, well, I'll wait one day to sell the calls. We have the jobs report tomorrow. You know, it has been robust over the last little while. Let's wait and see what happens there. And the opposite happened. It was not robust, and Goodyear went down to 9. I should have sold the 10s, but I thought I'd wait one more day. But I'm not too concerned yet. The puts I sold at 12 have not been put to me yet. I do have a long position in Goodyear Tire plus some puts, so it's not good overall. But it is at $9, low nines on weakness, on market weakness. If we get a bounce in the market, then I think we could find our way back to 10 on Goodyear. I think it's overdone. In fact, when Goodyear first released its earnings, the market initially reacted positively to it. It liked it. Same with GM. Pre-market, it was up and then all the way straight down. This seems to be a trend. NextEra, I sold more puts on that. $70 put, got 149 for September, and we saw XLU was up significantly. Duke Energy reports this week. Duke Energy shares the state of Florida with NextEra, so I don't know that Duke would see anything different than what NextEra saw. It makes up almost 8% of XLU, so there is XLU risk in there, but being that NextEra did very well, I think Duke will do very well. Duke's a big part of XLU. I'm not making any changes there. Annaly, $19 put, 42 cents for September. I also, as I said earlier, added to my short U.S. position against the peso. That's the same thing as saying I added to my long Mexican position, my long peso position against the U.S. Also, for the ETF EWW, 53 puts at $1.30 for September, 51 puts at $1.30 for September as well. Enbridge, another utility, but on the Canadian side of the border, $50 puts for September, 64 cents. The semiconductor index, the SOX, September, the 180 put, I got 380 on 180 puts. Oxy, continue to add to that, 57.50 puts, 231 for September, 55 puts, $1.77 for September, plus I did a December strip, 50, 47.50, 45, 42.50 for 294, 16.42% on invested capital, 43.54 annualized. Not as good as GM, but I don't mind owning Oxy at any of those prices. And same with SPY. I did a strip on SPY. The goal here is you have a market that's dropping. You have implied volatility that's increasing. If the market continues to drop, well then I will overlay this strip with another one. Instead of 50s to 42.50s, I might do 45s to 37.50s. But I'll keep overlaying it because I don't mind owning that company at those prices. I would be a buyer at those prices anyway, so I may as well get paid just to say that I would do it, right? I may as well get paid. If the market does this instead, here's what's going to happen to implied volatility. All these strips are going to pay off well because I'm selling them at very high implied volatility. If the market does a little bit of a bounce, I'll do even better because implied volatility will still drop. The premiums will come out of all of these puts plus delta. So I'll do very well. My hope is that before this happens, I will be able to buy a nearer term call. So I'd be looking at Oxy and I'd be looking at maybe a September 60 call. I'd be looking at SPY and I'd be maybe looking at a September 54, maybe a 54.50 or 5500 call. On ES, or if I'm looking at SPY 545, 550, I'd be using the funds I generate here, which would be excessive, to finance calls over here that are closer to the money. We'll see what happens. And if it works out that I buy calls and they don't work out, I still have my average put price over here would be 457.50. At 457.50 by December, I'd probably be a buyer of the broad market anyways. Okay, our forward 4-quarter operating earnings, LSEG and SPGlobal, closing SPX 53.46 gives us a 20.66 times forward multiple, down from 21.06. This is why I think it is ridiculous to think that the Fed is going to step in with an intermarket rate cut when we didn't have job losses. There were no job losses. Q2 GDP estimate is coming in at 2.8%. So you got a couple of negative data points. They say, oh, well, you got a market that's selling off. It's now overvalued instead of excessively overvalued. That's on you. That's your game. That's not my game. 20.66 is still well above a long-term 17 to 18 times earnings. Even if you want to say 19 is an average, you're still well above that. So you're crying because your market is only overvalued. Sorry, you're not going to get a cut. That's why I think it's ridiculous to be expecting a cut intermeeting. Surprise factor down to 3.6%, from 5% to 4.4%, down to 3.6%. Far cry from the 8.1% surprise factor from the first quarter, 3.6%. Enough companies have reported that it's going to be hard to change that number very much. So yeah, the growth in earnings is down significantly from the first quarter. Implied volatility 100% right across the board. To not sell that, I think would be a crime. Here we are way over here. If you go back over the last 52 weeks, it exceeds the implied volatility of the last 52 weeks altogether. Ending at 531.25, all-time high is 564 on July 16th. That is a pullback so far of 5.6%. That's not a market falling off a cliff. A correction, if we think about, every 10 months, 11 months having a 10% correction, that is not out of line of what the market has done historically. We're only at 5.58% on the S&P. So again, I don't think the Fed is having emergency meetings over that. The 50-day moving average is 543. So the 50-day moving average is almost 2% above where the market is now. Said another way, the market is 2% below the 50-day moving average. The 200-day moving average is 499.50, which is another 6.27% down from where we are now, or basically 11.5% below the all-time high to retouch or retest the 200-day moving average, which is more than a 10% correction. But the S&P is not at a 10% correction yet. Another 4% would put it there. In looking at the chart, you see this kind of thing over here, right? You see a bit of a head and shoulders. So if we draw a neckline and the head down to the neckline and extend that down, you're somewhere between 5,200 and 5,225 on the index, closed at 53.46. Maybe you get there. It really is only about another 100, 125 points down, maybe there. 90% at all-time high, 10% corrections at 508. We're at 531, another 250 points down on the index. If the sentiment continues into Monday, maybe you could see that. I don't know. I have a question mark there. I don't know. I haven't done anything with my original short position. I haven't done anything at all, but I am selling puts now, which means I'm adding beta, but I've kept my short position there. And we'll see what happens. If the market rallies, well, then the puts that I sold will help offset any loss there. But I could easily see, given this forward multiple, given the reduction we're having in earnings growth, given the reaction that we're having in the market, given the economic data that we're seeing, I can easily make an argument that we're not done with the selling yet. So that's why I have I don't know what to expect. It hasn't been the case with the market in the last couple of years that a little bit of selling is met with more selling. It seems that you pull back a few percent and then, okay, let's go. We're right back at the game again. and all of the euphoria is back, and we can't forget why we were ever bearish to begin with. But when we're bearish, we can't possibly conceive of being bullish again. And I think when you ended Friday, that's sort of the sentiment you left with, is how are we going to get that feeling back again? Keep in mind there is one big event. I think it's in 2 weeks, 3 weeks. There's one big event coming up ahead of us that will probably change, depending on where we are, will change the tone of everything. NVIDIA earnings. Is the AI story still alive? They've just killed it every single quarter on data center growth. NextEra, what did they say? That it was data center energy usage which really lifted their quarter. A big jump in that. Do you see that story is being over yet? NVIDIA, right? That is the big event sitting in front of us, because this market has gone up on AI euphoria. This is the general of that particular army. So we'll see what they have to say. In the week coming up, LSEG, 78 companies. Sector Spider, 75. SPGlobal, 71. I know they're not all the same, but I got to give them kudos for at least being close together this time. You guys are getting better. Except Sector Spider is actually 73, not 75, because they list a company that reports, they list them as two companies if they have two classes of shares in A and B. So they did that with two companies. So they're really 73. But hey, at least they're clustering. At least we're getting somewhere with that. Let's have a look at who's reporting, and we'll use Sector Spider's interface for that. Monday, August 4th, we have 4 companies in real estate. Simon Property Group, they're fairly large. And Tyson Foods for consumer staples. We have followed them before. Lamb Weston wasn't good. Tyson going to go the same way. Going over Tuesday, Duke Energy is reporting. Look at the weight they have in XLU, 7.79. They're significant enough. They share Florida with NextEra. I think they'll trade along with NextEra. I think their earnings will be in line with what NextEra. I think they'll see exactly what they saw, so I think they'll do well. You also have 2 more components of XLU making roughly about 9%. So you got 16-17% of XLU reporting on Tuesday, so it's a big risk event for XLU. Who else have we got in here? CAT in the industrials. They've pulled back a lot. They're still over $300 a share. This will tell us a lot about the health of the mining sector. Huge exposure to mining and with oil and gas exploration. Uber, and I think we have down here Airbnb. These two combined together will give us a nice feel of the consumer because these are both consumer driven, the ride sharing and the house sharing. Let's see how they do. Who else have we got down here? Yum Brands. Restaurants have been hit and miss. Lamb Weston big drop is primarily, at least they point primarily to the restaurant sector doing worse than they expected. Let's see how if Yum Brands falls in line with that. And who else have we got down here that jumps out to me? I'm pointing out things that that are interesting. Things that are interesting to me may be different than what's interesting to you, but at least you know where to find the calendar here. Super Microcomputer. Let's see how they do. They're an AI play. Moving into Wednesday, some risk here for me. Walt Disney, I have the 85 puts. Let's see how they do there. Oxy, well, you know I've loaded up on Oxy, and getting into Wednesday, if Monday and Tuesday tell me to do more. If Oxy pulls back, if I see 54, 53 on Oxy price, I will do more strips on Oxy for December ahead of earnings. I don't mind owning them. Let's see if there's anything else that jumps out at us here. Nothing that's interesting for me here going into Thursday. Again, I'm just looking for things that would jump out to me that are interesting. Nothing on my watch list, and again on Friday, nothing much there. Another utility, but very, very small. The big risk for utilities is earlier in the week is Tuesday, 16 to 17%. And that is it. I will be live on YouTube tonight at 7:15 for open Q&A.